This conference will now be recorded.
Hi, good evening, all. Hope my voice is audible to everyone.
Yes, sir.
Yeah, thank you for the response, ma. So let me know that my screen is visible to everyone. So can anyone confirm me? Is that my screen is visible to everyone?
Yes, sir. It's visible.
Okay, good. So in the last class, we have been seeing that how we can be able to prepare a balance sheet, a simple balance sheet. So now we are going to prepare a balance sheet based on the transactions values. So in the first transactions, we have been seeing that we have been received a existing accounts receivable amount. So we have reduced it. So we have used this value that minus 10,000 we have been received it. So it is going to get reduced, and we have received in the form of a cash. So we have been increased with the cash amount. So in the same way, I have been asked you people to try it out with the other transactions. So can anyone try with this? So what would be the effect of this transaction on the balance sheet? So company ABC purchased a new equipment for its factory worth of rupees 30,000 on credit basis. So what it is going to increase or decrease, or is it on both the side increase or both the side decrease?
Equipment will increase by 30,000 and simultaneously account payable will also increase by 30,000 because it is on
Very
credit.
good. Yes, good. So we have increased with the equipment value, and we are going to increase with accounts payable value. That's nice. The next transaction, received order worth rupees 5,000 from its customer in exchange for an expert supervision services. So here we have received something with a worth of rupees 5,000 on exchange of the services. So here we have making it a direct kind of a service, sales of services. So we are receiving the money. So here there is an increment of the cash value. So because of increase of cash, so there is an increase of a profit of the business. So hope you have been understood with this question. So we have increased with the cash, and we have increased with the retained earnings value. So the next question is, ABC made an expense worth rupees 3,000 to pay the vendor's bill. So when I'm saying that I'm going to make the payment, so it is going to get reduced with the cash of rupees 3,000. At the same time, by making the payment, so there is a reduce in the accounts payable which was supposed to be paid before, it is going to get reduced. Then the fifth one is, it has raised its capital issuing the shares to the public worth of rupees 1 lakh. So can anyone try with the values? So to which component of the balance sheet it is going to have an effect.
Sir, not sure, but I think cash will increase and owner's equity will increase.
Yes, it is correct. So we are receiving this through cash. So there is an increase in the value of a cash, and it is being considered as an capital. So it is going to increase with the owner's capital. Okay. So now try with this. ABC purchased raw material of worth rupees 12,000 on credit to produce its goods or services. So try with this.
Sir, inventories will increase by 12,000 and account payable will also increase by 12,000.
Can you repeat it, ma?
Sir, inventories will increase by 12,000 and account
Very good.
payable will also increase by 12,000.
Very good. Yeah. So the last one transaction is it has been purchased the equipment. So there is an increase in the equipment value of worth 10,000. So since it is purchased on cash, it is going to get reduced with the cash value. Okay. So like this, we are going to prepare the balance sheet by using the transactions. Good. So thank you for the responses. So let us try with the balance sheet with income statement value. So let us take it with the simple one. So the first transaction talks about rupees 1 lakh capital was introduced in the business. So it affects to what all the components of the income statement and the balance sheet, you can let me know. So rupees 1 lakh capital introduced in the business. Hope the screen is visible. So here the capital will be introduced. So I'm going to add the values for the equity capital of 1 lakh. So this 1 lakh has been received as a cash. So I'm not going to write the value directly into the cash because I'm not going to do the plus and minus in the same cell. So for that reason, I've kept as a separate column for the cash, whatever the transactions it is going to happen, I'm going to get it over here. So as a cash balances. So the total of this, it is connected to this. So I'll connect it over here equals to whatever the total amount it comes from here. So I'll connect it over here. So now let me give it the cash I've received is 10 lakh. So whenever you are going to show the value which is received, then it is a positive value. In case if the amount is going out of your business from your hand, so then you are going to show it in a minus. Okay. So this amount we have received it, so it is shown in the plus value. So the equity capital 1 lakh and the cash will be increased with 1 lakh. So the total liabilities is equal to the total assets value. The second transaction talks about the purchase of computer worth rupees 20,000, advance rent paid of rupees 10,000, deposit paid of rupees 20,000, and all these things has been paid. So that means the amount has been paid. So the value of a computer is 20,000. So when it is paid means it is going to be minus 20,000. So at the same time, there is a decrease in the cash balance. So advance is paid of rupees 10,000. So here it is minus 10,000. And the deposit is made of rupees 20,000. And here it is minus 20,000. Okay. So it has affected to the cash balance. So hope you people are able to understand till here. So till now it was connected to the balance sheet components. So the next thing is you are purchased 100 books worth of rupees 100 per book, and the amount will be paid after 30 days. Okay. So there is an inventory is purchased. So that is equals to 100 into 100. The value of inventory is 10,000 and this amount will be paid in the future. So the accounts payable amount is 10,000. Okay. So the purchase has happened. Now at the same time there is a sales of 50 books for rupees 200 per book. So when I say that there is a sales, so the inventory it get reduced. How much? Minus 50 books which is worth of 100 each. So now right now I have a inventory a value of 5,000, but I've sold it at 200 rupees per book. So which I'm supposed to receive it after 30 days. So 50 into 200. So there is a accounts receivable of rupees 10,000. Okay. So now when I'm going to say that there is a purchase and sales is involved in the business, so the income statement will appear. So the income statement says about the sales. So how much sales is that happened? 50 into 200, so 10,000. At the same time, to make this 10,000, we have spent 50 into, that is the unit sold into, the purchase cost is 100. Okay, so this is going to give us a profit of 5,000, where this 5,000 is being carried over to the balance sheet as a retained profit, so which will be added in case of profit with owner's equity. In case if it is loss, it would have been subtracted. Is that clear? So is that everyone understood with this a combination of income statement and the balance sheet? Okay, so this is how we are created. I want you people to try with this. The same similar type of transaction is there, but two more transactions are being added, two three transactions being added with this. So try to make it this one, and please share me the transaction. So I'll share this sheet today after the session, so you can just refer this and try to answer for this. Okay, yes. So this was our interconnecting with the income statement with balance sheet. Okay, so the next thing is we are going to talk about the depreciation. In the last session itself, we have been discussed about what is depreciation. So depreciation is a reducing the value of an asset based on its usage. Okay, so in the income statement, we were being able to depreciate the value. So we have been taken this example. So we are going to calculate this value after the EBITDA value. So what is the value of an depreciation? The formula to calculate depreciation is value of an asset divided by number of years of life of that asset. So the value of an asset is 2 lakh divided by number of life of years. So that is 4. So this will be the same value for all the financial years. So this the depreciation value remains the same for all the years. Okay, but when it comes to the balance sheet, so depreciation will be shown in your uh, income statement. At the same time, in the balance sheet also we are going to show the uh, depreciation value, but here it is called as an accumulated depreciation. So accumulated depreciation means you are going to calculate the depreciation value by adding up with the previous year value. Okay, so here the value of an asset is going to remain the same for all the years. So as the usage it is going to happen for every year, so the value of an asset it is going to keep on get reducing it, so that once it is going to get ended with its life of the year, so it is going to be a null value of an asset. Okay, So here let us take it equals to value of an asset is 2 lakh divided by 4. So this is year 1. So that is 50. So here the PPE stands for. Can anyone try what is PPE means? Okay. So plant property and equipment. So it could be the total value of an asset. So that is considered as an asset. So the net value of an asset is PPE gross minus the depreciation value. So this is going to be the first year depreciation value. But when it comes to the year 2, so it will be current year's depreciation value divided by 4 plus the previous year depreciation value. So this becomes as 1 lakh. So the value of an asset minus accumulated depreciation. So this you can calculate it the same way for the other years. By the end of the years, the end of the period, so it is going to be a zero value of an asset. Okay, so I'll just put this. So you can see this, the calculations what I have been done with. So kindly go through this and please practice with the same way. Okay, so I have been given with the case number 2. So kindly do with this calculation. Can anyone try? Can anyone try for this? So the first year, take the PP gross value divided by the number of years is 5. So this will be minus PP gross minus accumulated depreciation. From the year 2 onwards, the depreciation value plus the previous year depreciated value, and this will be minus with PP gross minus accumulated depreciation value, and so finally the last year it is going to be 0. So the next case it is going to be on the percentage. So till now you were being calculated by divided. So when it comes to the percentage, you should give it with the percentage value. So that year into 20% plus the previous year. So select and drag it. So that at the end of the financial year, it is going to be 0. Okay. So this is how you are going to calculate with accumulated depreciation value. So the next thing is there is a cases that you will have a development phases. So here it says the cost of a machine you are going to use it for your manufacturing. So it is not going to get installed at the same time. So it is going to take some time. So the total project of the total project, the tenure is 7 years. In that the 3 years will be development phase and the 4 years will be execution phase. So the first 3 years, so you are not going to consider anything as a calculation. So what is the value of an machine is 40 lakhs into 30%. The same thing I can also give it as, instead of manual I can give this. So where it is going to be the same value for all the cells which I am going to drag it. So I'll keep it as a freezed value into 30%. So first 3 years when you are going to calculate it, so the total of this value is going to become as 40 lakhs. Okay, so from the 4th year onwards it is going to be the same value, 40 lakhs for all the years. Since you are not going to do any kind of implementation, so it is going to be 0. So until and unless you have started to use that machine, so you are not going to have any depreciation. So from the year 4 onwards, when it starts with the execution phase, so from there it is going to be started with the depreciation. So total asset value divided by 4 years for the year 1 plus, sorry, it is year 4 plus the previous year, and this becomes minus depreciation value. So finally, at the last end of the financial, I mean the period, the lifespan of the project, it is going to be the asset value will be 0. Okay, so you should read and understood with the problems what you are going to have it. The situational wise, you are supposed to implement this, the formulas or the functions. Okay, so this is one kind of a calculation of accumulated depreciation. So the next part is retained profit. So retained profit, that means the profit which you are going to get it through an income statement. So that you are going to show it in your balance sheet under capital or owner's equity. So as per the information here, the capital value is 50 lakhs. So I'll select this value and I'm going to freeze this because it remains the same for all the years. So since I'm not going to bring any extra fund, so it is going to remain the same for all the 4 years. So the retained profit should be connected from the income statement of that particular year, whatever the profit is there, that plus the previous year. So before the previous year, that is before year 1, there was nothing, no profit. So I'll give it as 0. It is similar to your accumulated depreciation value only. So you are going to calculate the value with the previous year value. Take the current year value plus the previous year value also. And here it is going to get added. So shareholders fund plus retained profit. So for the year 2, the retained profit is the current year's profit plus the previous year's profit, previous year's retained profit. Accepted. So I'll just write it over here itself. So accumulated depreciation calculated on current year depreciation plus previous year accumulated depreciation in balance sheet. So current year depreciation value from income statement, so that it will help you to understand easily. So previous current year depreciation value from income statement plus previous year accumulated depreciation value of balance sheet. Okay. At the same time, when I'm going to calculate the retained profit, so here also it is the similar type only. Retained profit calculated on current year's net income value from income statement plus previous year retained profit value of balance sheet. Okay. So the current year net income plus previous year retained profit of the balance sheet. Okay. So this is how you are going to calculate with retained profit on the balance sheet. Okay. So let us take the example over here. So in the case number 2, so we are going to consider the shareholder capital contribution is 8 lakh. So the retained profit. So can anyone try to let me know what would be the retained profit? Can anyone try? Even if it is wrong also it's okay. Try to find the answer. So I'll put that statement over here also so that it may be helpful to you to read out and give me the answer. Let me hope any one person can try.
So return earning for first year it will be 1,20,000.
So 1,20,000. Good.
And total OE will be 8 lakh plus 1 lakh 20,000. That is 10
Very
lakh
good.
20,000.
9 lakh
Sorry, 9
20.
lakh 20,000.
Good. So for the year two,
And that will be 1 lakh 40,000 plus 1 lakh 20,000.
good. And this will
And
be
8 lakh plus 2
8.
lakh 60,000.
Very good. Thank you. So now from the year two onwards, you can be able to drag it. Okay. So this is how you are going to calculate with accumulated depreciation and retained profit value. So by using all these values, we are going to prepare with the balance sheet. So in the previous to previous class, we have been seeing that how you can be able to prepare the debt schedules. Okay. So the debt, if the loan is taken of 5 lakh, if no repayment is done for till 4 years. So here we don't pay every year. The repayment will be 0, 0, 0. The fourth year we are going to pay it. There will be some situations that they don't take the money till the end of that period. So this is the repayment can happen. Okay. So there are situations. At the same time, there are people who are going to ask to pay the money with the equal installment for all the years. So the debt is 5 lakh. The repayment, it will be equally for all the 4 years. That means equals whatever the value of the debt is divided by the period is 4. So every year you are going to pay it with 1,25,000. So this remains the same. Okay. Now the net of the debt will be debt minus the repayment value. So 3,75,000. This value will be carried out for the next year. Okay. And this will be this minus this. So the same way you are going to calculate it. So that end of the fourth year it is going to be ended without any balance. Okay. So in the previous to previous class when we were doing with the debt schedule, so we were doing it with EMI, EAI. Okay. So there we had interest amount and principal repaid. So for that reason, we had to calculate EAI with the PMT formula. But here it is straight away it is given that your repayment is done 4 years equally. So there is nothing like you are going to implement the PMT formula. So please read out the things and then do the calculations. So hope this has made you people to understand with this. Okay. So the next situation is this one. So in the, as I said, the debt schedule preparation. So we have already done this. So how to do this? If you people remember, guide me how to prepare this debt schedule for the 4 years. So I'll give a 2 minutes of time. So can anyone think, recall, and let me know? Okay, we'll do one thing. We will have a 5 minutes of break and we'll come back at 7:30 and we will resume the session. So meanwhile, you can think about this and let me know the answer. Thank you all for being online. So can anyone let me know so how to do with this debt schedule calculation? So I'll repeat it once. So once you see with this, and then let me know that have you understood with this concept or not. Okay. So when you are going to prepare the debt schedule, especially for the EAI, that is equal annual installments. So you are going to prepare it in the column columnar wise. So there are 4 years means you are going to add it as a year zero. So end of the period, the debt value will be the loan amount what you are going to take it from the bank. So the loan amount here it is 5 lakhs. Okay. Now the last year's closing balance will become the opening balance for the current year. So you are going to connect it with the previous year closing balance in the opening debt value. The next we are going to calculate the EAI. So we are going to use the formula of use the function of PMT. So can anyone tell me that how do we give the value of a PMT? So we are going to give it with the PMT function name activated by opening the bracket. So what is the rate of interest here? So can anyone let me know what is the rate of interest we are going to give it over here? So can you help me out how to calculate with the PMT value? Hope everyone are able to hear to me. So the rate of interest is 15%, comma, the number of period, the loan period it is for 4 years, comma, present value. So as you all know that we are going to give it in the minus value, minus 5 lakhs, comma, future value is 0, comma, we are going to calculate it for the end of the period. So we are going to give it as 0 and close the bracket. So 1,75,133 is the EAI amount we are going to calculate it. So the next thing is interest expense should be calculated for the current year's opening balance into the interest rate, that is 15%. And principal repaid it will be EAI minus principal interest expense amount. And finally the end of period debt, it is going to be the opening debt minus the principal repaid will give me the closing. Okay, so if you are going to do it for 1 year and if you drag it for the other years, it should give me the answer at the end of the period. It should be zero value. Okay, so you should be very careful when you are going to do it with the debt schedule. So make sure that everything is properly calculated in the year 0 to year 1. So if these two things are correct, and if you drag it for even for 100 years also, so it is going to get calculated automatically. So this is a major one. Okay, so this year one calculations, it should be very much clear. Okay, so I'm going to give it for the debt schedule for 7 years. So please try it out from your end. Okay, yes, so it is only case 2 is there. The next thing is, finally we are going to prepare the balance sheet by having this information. So now you people are going to give me, so tell me how to bring this values. So how do I calculate this assets liabilities value? So please tell me what should be given in the PPE gross value. Can anyone tell me what is the PPE value in this balance sheet? So if you have got an idea till now, so finally we are going to prepare this balance sheet. So can anyone try this? So as soon as we are going to finish this balance sheet completely, so we can wind up the session for today. So it is up to you people how much fast you people are going to finish up with this. So that much fast we can be able to wind up. So I think this could be an offer to you people. So take a minute of time and try to feed it up with the right values. Okay, so let me try it out from my side. So I think most of them have got very much tired of doing it from the morning. So let me try to solve this. Okay, so here the PP gross value is nothing but the asset value. So the cost of the machine, here the machine is an asset. So the cost of the machine is 75 lakhs. So this will be, and you should observe in the balance sheet, it is going to be given from year 0 onwards till the end of the period. But when it is prepared with income statement, there is no value will be given for the year 0. It is from the year 1. Income statement present. So balance sheet, it is going to be like your report card, which will be having from the beginning to the end. Okay. So PPE gross. The cost of the asset is 75 lakhs. So this remains the same for all the years because there is no increment of asset in between. Okay. So the next thing is the depreciation value. So for the year 0, there is no depreciation because once you start to use the asset, then only you are going to calculate with depreciation value. So year 0, it is 0. Then for the year 1, it is going to be equals to the current year's depreciation. So how do I calculate it? So either you can be able to use this asset value divided by the number of years, or here already it has been given in the income statement as a depreciation value. So here it is given as 18 lakh 75,000. So if you calculate also, it will be the same. So example, if I take this divided by 4, so it will be also 18 lakh 75,000. But still, as the value has already been given in the income statement, so I'm going to take that value. So 18 lakh 75,000 plus the previous year's accumulated depreciation value from balance sheet. So first we have to take it from the income statement, the current year's depreciation value from income statement plus the previous year accumulated depreciation value from the balance sheet. Okay. So same thing it is for the year 2. So the current year plus the previous year. Same way for the next current year plus the previous year. And finally, when it comes, the depreciation value should be equals to the asset value. Okay. So now the PP net value will be equals to PP gross minus with accumulated depreciation value. Okay. So this, if you drag it, you can see that at the end of the period, so the value of an asset is 0. Okay. So the total asset value now, it is going to be equals to the cash balance. There is no cash balance for the year 0 plus the PP net, the final amount of the asset. Okay. So this will be the total asset value. Okay. So now this has to match with your total liabilities value. Okay. So now the first thing in the liabilities, it is asking about net debt. So what is the net debt? So here we have to see that the cost of the machine is 75 lakhs. Suppose if I have brought the money directly to the business in the form of equity, that is share or the capital. So directly if I brought it in the form of cash, then I would have been shown it as a capital or owner's equity as a 75 lakhs. But here it says that equity what you are, the capital what you have brought, it is in the two format. One is 75% of the value you have brought it as a debt. That means you have taken a loan on it. Okay. So the 75% is nothing but 75 lakhs into 75%. So 56 lakhs 25,000 rupees of debt and remaining as a cash. So this into 25%. Okay. So now you have to take this value. So if I want to know what is the net debt of that year, so you have to prepare this debt schedule. Okay. So what is the loan amount I'm going to take it? It is nothing but equals to this is the debt amount. So 56 lakhs 25,000. So equals the previous year value, that is the end of the period debt of previous financial year will be opening balance for the next financial year. Okay. The next thing is AI. As we know that PMT rate is 15%. The period is 4. The present value, that is 56 lakhs 25,000, is the loan amount. There is no future value. There is end of period calculated. So 19 lakhs 70,243 is the EI value. So the interest expense will be on that current year's debt value into 15%, and this will be EI minus the interest amount, and finally UOP debt will be current year's opening balance minus principal repaid. So we will come to know that it is going to be at the end of the period it is zero value. So now what is the net debt value is the end of period what the value was there. So this amount has to be carried to net debt in the liability side. So from the year 0, okay, and you have to drag this. The next equity value will be 18 lakh 75,000, and this remains the same for all the years. Okay, then retained profit will be equals to the current year's profit. There is no current year, that is year 0, there is no profit, it is 0. Then in the year 1, bring it from the profit after tax plus previous year's tax, and if you drag it, so it is going to get connected with the previous year value plus current year's profit value from the income statement. Then finally the total liabilities will be calculated, the net debt value plus equity plus the retained profit. So sum it up with all the values and check it out. Okay, so now you see that when I see that the total asset should be equal to the total liabilities. So if you find any difference, that means the balance sheet is not balanced. Okay, so prepare it, the balance sheet, in such a way it is going to be balanced. Okay, so this is how you are going to prepare a final balance sheet. Okay, so I'll share this document to you people once again today with all this activities what we have done. Please practice this and let me know in case of any doubt if you have it. So I have asked in the last class to you people to share the screenshots of the income statement you have been prepared it. I think Samprita had been seeing your document. So there was some changes was supposed to be done what I felt it. So I'll just show you that what was the value to be there in the income statement where you went wrong. So I'll do one thing, I'll just share it, the document which we have been completed. Okay, so there you will be able to find it where you have made a small mistake. It was a small mistake. Okay, so let me check it out. And thank you, Samprita, for trying it. I request the other people also to try with it. Okay, so finally I was supposed to get it EAT value of 19,000. So you have got it with the 51,000. So anyway, I'm going to share it, the document, to you, to others in the group, which we have completed now. So please refer these documents and practice it. Okay, so we'll meet in the next session. Thank you all. Have a wonderful time.